Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. No news, maybe good news on Wall Street today. It was a mixed bag for stocks. The S&P flirted with a flat line most of the day, and tech stocks gave some life to the Nasdaq, with Nvidia and AMD helping boost that index. The Dow ending the day lower. And a possible collision course as billions of dollars may be on the line surrounding electric vehicles if a tax credit incentive is axed. There could be a ripple effect on the auto industry and potential investments in the sector. We're taking a deep dive into all of the implications. And a slew of problems we know are being born from tariffs, including key products parents rely on for their babies. We're going to unpack what's at stake, from manufacturing to supply chain challenges in the world of essential devices for kids and families. We're talking with the co-founder of the popular retailer Lalo. Well, investors bracing for a potential repeal of EV tax credits in President Trump's tax bill. From what that means for the industry, we're bringing in now Brent Gruber, J.D. Power, Executive Director of EV Practice. Brent, it is good to see you. So it sounds like we could be saying goodbye here to that EV tax credit, Brent. If we did, walk us through what you think the ripple effects, the implications would be for EV sales, for EV adoption.
Yeah, if that does in fact happen, Josh, you're potentially looking at a double whammy with tariffs and the elimination of the tax credit. You're talking about, what is conceivably a $12,000 plus swing on the price of an electric vehicle. Certainly electric vehicle shoppers are price conscious. We've seen some impact on price fluctuations over the last couple of years. Particularly when there are incentives and pricing actions taken on the sales of electric vehicles, generates a lot of interest. So if those tax credits go away, you're going to see probably a slowdown in the level of interest for electric vehicles.
And how, Brent, would you see that potentially impacting the automakers? I'm thinking GM and Ford and just sort of their broader EV ambitions, Brent.
Well, at JD Power, we have this saying that we say, one in, one out, and two in the middle. And what that means is, out of every four shoppers in the United States, new vehicle shoppers, one of those four is very much interested in an electric vehicle and is highly likely to consider purchasing one. And then one of those shoppers is, highly likely to not purchase one. And then there's those two in the middle, where I think you'll see, some movement is with those folks in the middle who are maybe on the fence, thinking about purchasing an electric vehicle. There's a market among the consumers who are very set on buying an electric vehicle, but it's really going to affect those people in the middle who may be on the fence. And that's a very large percentage of the buyer population.
I'm also curious, Brent, to get your take on how you think it could impact, if at all, Tesla. I'm curious whether you think Elon Musk is maybe in some sense better positioned there, Brent. Does he have kind of more financial flexibility to lower prices if he had to?
Well, I can tell you from a data perspective and what we see at JD Power, I think that Tesla is very susceptible to the elimination of the tax credits, just as other manufacturers are as well. One of the things that we do with our study is we track the influence of those tax credits on purchase decisions. And when you look at the brands that are most affected by those purchase prices and that tax credit, Tesla is right up there at the top. So I think that they're very susceptible to the elimination of those. Now, whether or not they have some pricing power to be able to offset some of that, I think that remains to be seen. But from a consumer perspective, Tesla consumers are very much, utilizing those tax credits.
I'm curious, Brent. Listen, Tesla's a name we talk a lot about on this show. Have you seen any data, Brent, that gives you perspective on how EV shoppers feel about Tesla? They're sticking with it. They're moving away from it.
Yeah, we do. So, what we're seeing is in the buyer population, there's still a tremendous amount of interest in the Tesla brand. It's still the largest market share brand in the EV space within the United States. Consumers are still very much interested in those products. What you are seeing is, some consideration for other brands. So manufacturers that didn't have electric vehicles before have now rounded out their portfolios with EV products. products. And so consumers are considering products from those other brands. So naturally, you expect that interest in Tesla as a brand to diminish as competition increases. In addition to that, there's certainly, some consumer sentiment for and against some of the actions, taken by Elon Musk in the political arena. So we have seen some impact from that, but largely very much impacted by other products coming to the market and just the increased competition.
That's interesting. A final question here, Brent. If we did eliminate the tax credit, I'm just curious how, if all, you think that affects global competition, specifically with the Chinese EV makers?
Right. Well, right now, there's certainly a big impediment to the U.S. market for Chinese manufacturers, and so domestically here within the U.S., what impact that will have on the manufacturers here, I think it remains to be seen. If there's a cost disadvantage that those manufacturers will have, I think it's going to probably slow down the transition to electrification. One thing is certainly clear, Josh. We're absolutely bullish on the future for electric vehicles. I think the question is just a matter of how quickly that's going to accelerate.
Brent, great to have you on the show today. Thanks so much for your time. We appreciate it.
Thank you.
Stick around. Much more Ask for a Trend. That's still to come. Well, the Nasdaq notches its sixth day of gains as chip stocks lead the tech rally, and Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
All right, Josh, we are going to start with the chip sector, specifically that big stock we always talk about, Nvidia, right? So more gains in the Magnificent Seven, leading stocks higher today. And I want to take a look at just Nvidia's gain that we saw today for over 4%. And then I was zooming out, Josh, over the last 6 days. Look at this rise in the AI chip leader, 19%. Wow. I mean, stock's been absolutely ripping. So Nvidia now, if we flip to a year to date here, as of today, it has erased all of its losses for 2025. At one point, that stock was down 30% on the year. Gives you a sense of how big this rally has been. A final point just on the Mag 7 cohort as a whole. If we look year to date, still not all of these stocks have recovered. And then you look at that Mag 7 index that encapsulates all of these stocks, right? So you've had recovery in the Qs, recoveries in SPY, the S&P 500 ETF. Mag's still down on the year though right now.
For the Mag 7 names, what's the next date on the calendar?
So you have Nvidia earnings coming in 2 weeks, right? So I think that's going to be a big moment for the stock overall. And I think just looking at that earnings season and how Nvidia kind of rallies maybe into that, right? So you have this big rally going on in Nvidia, like I just pointed out. Does the stock keep moving higher into earnings? Because we've seen the last couple quarters, a lot gets priced into that stock, right? Nvidia comes out, I mean, they keep beating, right? They beat and raise, but it doesn't always necessarily help the stock. If you see a big rally going into it, so I think that's going to be interesting to watch the next couple weeks.
All right, Schaefer, number 2.
Point number 2, Josh, is on the index as a whole. So right now, people are starting to talk about market valuations again, right? So when you look at the market, this is from Data Track Research, Nick Colas is pointing out, probably just essentially fairly valued right now on a forward 12-month PE ratio. So you see the bounce that we had here, we were down here. People start to talk, oh, index is getting cheap, index is getting cheap. You're not that far from the highs that we've seen recently, right? And so now you just sort of have to think, how do we get higher from here? And that becomes, I think, a little bit difficult to some extent.
So if an investor, and I'm looking at that chart, I'm thinking, okay, well, I'm betting that more good news better be on the way.
Exactly, right? And I think, so what is that good news, right, is sort of the key question here. And it's probably some solid economic data. Of course, that's still a concern, right, is what did these tariffs before they were paused, how did they impact the economy? What do we find out over the next 2 months from that front? And then also just, does this administration continue to be a little bit pro-market, right? I think a lot of the bulls right now on the street are pointing out, well, when the market got shaky, felt like the administration stepped in. Do they stay kind of pro-market, and as these deals get made and these negotiations go on, are there no more hiccups? And does the market feel confident? Seems to sort of be a key talking point right now.
All right, final point.
This is, if you're looking for reasons to maybe be bullish or get a sense on sentiment, just looking at some of the stocks that are going up, Josh. You flip back a month ago, and the names that we talk about that end up on maybe our trending tickers page, or I'll click on ARK here, some of the names that are within that index, look at how much some of these stocks have moved. You got a Tesla up 26%. I'm gonna flip over to our AI board if I can find it here. And the AI board, within that, you had Supermicro up over 15% today. You had Reddit was up 15% also at one point. Just starting to see euphoria in some of the names that are heavily shorted, and then also a little bit more risk on, and you kind of get a sense that maybe the market is getting more risk on.
Does that when you see those kind of names having those kind of moves, that suggests to you a bit of euphoria maybe creeping in?
I think so, Josh. So let's just look year to date at a super micro, right? I mean, the stock was not doing great at this point, and then we'll go to, where's my Tesla board if I can find it, Josh? Tesla is, I think, a good version of this sentiment too, right? Basically stocks that fall more when the market's falling, right? And so look at what happened here, right? Tesla just sort of gets whacked from the bottom, and you can sort of get a sense that people aren't really buying into some of these riskier names as it starts to come up sharply. Okay, maybe we're starting to feel risk on, and I'll highlight one more for you. The move in Palantir over the last couple weeks has been crazy, right? And I think they reported earnings recently. That was accepted well. But this isn't all earnings, right? This is a vibe in the market that we want to buy AI stocks, and what's my next AI winner, and people are looking for it in Palantir.
I remember heading into that print, that stock was up about 400% over the past 12 months. It's remarkable. Thank you, Josh. Appreciate it. Stick around. Much more Ask for a Trend. That is still to come. Tariffs are set to make the price tag of parenthood even more expensive, but will the newly negotiated lower tariff on imports from China be a big enough difference? Well, joining me now to discuss is Michael Weider, Lalo, co-founder and president. Lalo is the maker of baby and toddler products. Michael, great to see you here on set.
Thanks for having me.
So maybe just to start, Michael, for the uninitiated, talk a little about the mission, the history of Lalo, and what sets you all apart in the market.
Yeah, I mean, we launched the brand just over 6 years ago because we thought parents deserve better. I mean, when we launched the brand, so much was predicated on building up fear and anxiety in parenthood. If you don't buy this, your kid's not going to sleep or they're not going to eat. And we said, let's flip that on its head. Let's treat this through love and connection with our customer, our parent, and that's kind of how we built the brand to where it is today.
And so now, spin ahead, now like so many small businesses, you're dealing with this new dynamic of Trump tariffs. How are you dealing with that, Michael? How are you navigating that?
Yeah, I mean, the last few months have been tiring, if nothing else, especially with kids at home. And so, we've had to do a lot of work. We've had to run lots of scenarios. We paused our imports for a while the major tariff was still on, and we just opened up and put stuff on the water this week so we can get goods here and avoid going out of stock. But it's been a lot of hard work. I mean, for us, it's really been about protecting parents and making sure that they can continue to get the products they trust at a fair price and keep looking out for them.
And walk me through your supply chain. How much is coming from China?
Yeah, I mean, right now about 90% of our products do come from China, but that's because there's decades and decades of experience of factories that are making regulated products at the highest quality, ensuring their safety. That knowledge doesn't exist anywhere else out in the world.
So we know what President Trump wants, right? He wants more stuff made here. Is that financially tenable for you, Michael?
Yeah, you know what? Honestly, we've looked into everything. So are we going to commit to our Chinese partners? Are we going to look elsewhere? How are we going to do this? Are we going to bring it back here? And we've looked into American manufacturing. We've had great conversations with American manufacturers. And honestly, it's not the type of manufacturing that wants to be done here. There is some stuff maybe in the long term we could bring here, but it's going to take a while. It will take years to get it spun up correctly. But the more regulated products, where's that knowledge and history, you lose a lot by moving it out. And we don't want to risk the safety and the quality that parents rely on.
So as you think through these tariffs, though, Michael, now you do have to navigate this. How do you think through that? I mean, is that, okay, we can eat this cost, we can pass it along to parents and customers, some mix of the two? What's the game plan?
Yeah, well, we launched in Target just about 6 weeks ago, which was a massive milestone for our brand, and we actually dropped our prices in January ahead of the tariffs. We knew tariffs were coming. It's talked about in the campaign. And we said, we don't want to be more of the burden. If the avocados are going to cost more, we don't want the high chair they're sitting in to cost more as well. So we cut prices on a large percentage of our products. And so we did that already. Now we're looking and saying, if we have to raise prices, can we at least keep it below where it was before? And so we're going through everything. We've had a dozen or so scenarios of where these tariffs could land and even where they could land in the future. This 30% is a short-term breath. You could take a short-term breath, but it's not clarity. right? And to run a business, you need long-term clarity.
If we can put tariffs aside, I'm also just curious to get your take. What kind of just underlying demand has looked like versus 6 months ago versus 12 months ago? Because you have, Michael, I mean, pretty just interesting line of sight into the consumer.
Yeah, I mean, demand is strong, right? Yeah. Customers are definitely, we are urging customers to get out there. If you are expecting a baby, get the gifts now. Tell your gift givers to buy those gifts now in case prices do go up. And we're transparent. We're sending emails every Tuesday to our customer base about what we're doing, what they can expect. Right now, we're not raising prices in May. We told them we're going to give them plenty of heads up. And actually yesterday, I held a public AMA with our customer base to answer all their questions. And I had over an hour of questions coming at me, just all sorts of things. Are prices going up? What can we expect? Are things going to go out of stock? And parents are worried, right? And we want to make sure that they feel comfortable and we peel back any kind of the opaqueness that they're feeling right now.
And Michael, who is your customer? I mean, the average Lalo customer, what the age, income, demo, region?
Yeah.
Break it down for me.
I mean, we're a premium brand, but we appeal to a large swath of the American parent. You know, we're now nationwide at Target. We have products that start at $9.99 and go up to $400. And so there's something for everybody to live and breathe the brand and be a part of what we're building. But it really ranges. It's, you know, a lot of it's first-time parents. It's those parents with the deepest anxieties, and we want to make sure those anxieties are brought down to a reasonable level, especially now.
And Michael, final question. I'm just curious. Are you all, as a small business owner, a successful one, are you talking to politicians and lawmakers? Are you having conversations? And if so, what are you telling them?
Yeah, we've had some really interesting conversations. The biggest thing is that the first administration under Trump actually had an exemption on baby products for what were the Section 301 tariffs. Not to get too particular, but there was an exemption. There's a precedent that this president has already set on exempting baby products. So we're advocating for that baby products should be exempt because no one wants parents to pay more. Childcare is already expensive, healthcare is already expensive. They don't need more cost.
What kind of response do you get when you make that case?
It's obvious. Honestly, it's a pretty obvious response. And of course, a lot of these people are parents or have kids that have grown up and they get it. We've had conversation with multiple centers. And the other thing is we're breaking down barriers of competition. We're talking to people we compete day in and day out with to say, let's join forces to talk to lawmakers as well and bring power in numbers to the Hill.
Final question for your customers who are listening right now. Any new products, category expansions that are on the way, Michael?
Yeah, so I mean, one thing that I was worried about with the tariffs that we wouldn't be able to get new products here because we've been hard at work on some new stuff. We're launching something really cool and new next month in the feeding space, which we're really excited about. It's a brand new product we haven't entered in before, and it's going to launch on our site first, and then it's going to be available at Target nationwide. So we're really excited about that, and then lots of new stuff for next year across all new categories within feeding, play, and bath. So lots of new stuff you can look for.
We'll bring you back to talk about all of it. Michael, so good to see you. Thank you so much. Appreciate it. Treasuries may not lead during good times, but when recessions hit, they've historically offered powerful protection for investors. Yahoo Finance's Madison Mills joins you now with a closer look in our chart of the day. Maddie.
Bonds, the ultimate protector and the ultimate snoozer for portfolios. I know you don't love to talk about treasuries when big tech is in the room, but trust me, you're going to want to hear this. Take a look at this chart behind me. It looks at the performance of bonds, U.S. treasuries, compared with stocks throughout business cycles. So over here, you've got the start to the midpoint of your cyclical expansion here. Stocks obviously outperforming your treasuries. Then when you go to the middle of this chart on your screen here, you can see that in the midpoint to the end of a cycle of expansion, you start to see a little bit more similarity, but stocks still beating bonds. You're thinking to yourself, why do I have this drag on my portfolio? Well, at the end here, you get your answer. Stocks tend to underperform bonds by 13% during times of recession. And you can see here bonds outperforming stocks by 19% in a recessionary period. This is all part of what we spoke with Matt Stuckey about. He's the Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management. Here's what he had to say.
But let's say you're a mixed investor, half in equities, half in fixed income. We'd actually recommend a little bit more fixed income above and beyond your target. And the reason being is simply return skew. Right now with the 450 10-year, let's call it, shock interest rates up or down 100 basis points and look at what happens over the next year in terms of total return. Well, if interest rates go up 100 basis points, you're down roughly 2.5%. But if they go down 100 basis points, you're up roughly 12%. And so the risk return skew there to us is attractive.
And Matt making those comments at a really important time in the market. Why is that? Where your 10-year yield hit that critical level of 4.5% today. It actually hit just above that. So when you see yields at those levels, it's really hard to argue against getting into those 10-year notes when you can get a 4.5% clip on them when you have a lot of volatility driving the stock market. We still don't have trade deals. We just have frameworks, talks of deals, and all of that volatility is still in the room for stocks here. Now, what's going to be interesting to note, as Matt pointed out, what happens with the Federal Reserve. Of course, that is a key driver of where we might see the 10-year yield heading. And then, of course, I do want to quickly mention the Trump administration. Treasury Secretary Scott Bessent has said it's his goal to keep the 10-year yield as low as possible. So that is a potential risk for investors. But that really stood out to me, what Matt had to say about how, historically we have a 60-40 spread in a portfolio, but he's recommending an even bigger allocation to bonds going forward because of all that market volatility that I just mentioned.
All right, thank you, Maddie. Appreciate it. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow, 4:30 p.m. Eastern, for all of the latest market room stories affecting your wallet. Have a great night.